Now, as I mentioned in the previous video, Silver Lake, an American private equity firm, has recently invested $500 million for just over a 10% stake into Manchester City owners City Football Group. Today, Silver Lake has assets under management, AUM, of $43 billion, and is focused on leveraged buyouts and growth capital investments in tech and tech-enabled businesses. However, Silver Lake has an interesting story, so let's take a look at that now. Silver Lake was founded in 1999 and within months of creation had already gathered more than $2 billion in commitments. This was for its debut buyout fund focused on the tech industry. Everybody who was anybody at that time in Silicon Valley and Wall Street had invested in Silver Lake. These included Bill Gates and Michael Dell via their money managers, and also Larry Ellison, as well as all the big cheeses at the investment banks and institutions such as General Motors Pension Fund and Stanford. Now, the founding team was one of the most unique in recent private equity history, and this played a large role in how well they were able to fundraise early on. In fact, they were known as the Four Amigos. Jim Davison was a former investment bank managing director, Glenn Hutchins was a buyout expert from Blackstone, Roger McNamee was a superstar Silicon Valley investor, and Dave Rue was a one-time executive at Oracle. McNamee was also a touring musician. Now, at that particular time, tech LBOs, LBO just means leveraged buyout, weren't really a thing. This is because tech companies at that time had lofty valuations, a lack of earnings, and volatile profits. Now, before Silver Lake was formed in 1999, investors could buy shares of public tech companies via the stock market, or they could, if they were accredited investors, invest in private tech companies via venture capital. Now, as we can see here, the Nasdaq was around 440 in January 1990 and around 3,600 in December 1999, which is roughly a 9x. Now, of course, the Warren Buffett phrase, "be fearful when others are greedy," comes to mind here. Instead of investing in these highly valued tech companies, Silver Lake instead focused on slower growth tech companies that weren't being shilled regularly by Wall Street. We can see here why the timing was pretty good. This is because the tech bubble popped hard from the end of 2000 to around mid-2002. It is actually currently sitting around 8,600, which is not too far from double the top of the bubble in 2000. Of course though, the current climate is completely different, valuations are not lofty, there are not issues around profitability, and everything is fine. So what is a leveraged buyout or LBO? Well, an LBO basically means that you use leverage to buy out a company. The target for such deals is usually undervalued companies with strong cash flows. This is very important as a key driver in returns is the ability to use cash flow to pay down debt. Now, you are using leverage debt to buy out the company, and you use the cash flow of the company to pay down the debt, because obviously the debt carries some interest. Now, assuming that cash flow can be used to pay down the debt, and you can improve operations in the business and improve the valuation of the business, you can therefore sell at a tidy profit. And this is a key driver of high exit multiples in the private equity industry and generally high returns. That should provide a general overview, but for more detail, check out my video on the types of private equity deals. Now, looking at the tech industry at the time, Silver Lake spotted an interesting trend, and they called this the secret sauce in their research. They found that 50% of all publicly traded tech companies sold on average for 1 times annual sales or less, many of which were still posting top and bottom line growth of 10% or more. Traditionally, of course, that would be attractive for investors, but the herd mentality of seeking rapidly growing tech companies at that time had left a part of the market underserved, and Silver Lake sure capitalized on that. This is really one of the key reasons why Silver Lake was able to raise $2.2 billion in just a few short months, because institutional investors at that time were craving a way to play technology that was less crowded and less expensive. In fact, the Silver Lake partners said that they could have raised $4 billion, and that the biggest challenge was cutting their limited partners, the investors, back. As we can see here, it was a relatively slow start in terms of the number of deals. But the deals that the firm does pursue tend to be larger in scale. For example, since the beginning of 1999, Silver Lake has invested in 25 deals worth at least $1 billion. The firm operates 4 distinct strategies. The biggest, which is Silver Lake Partners, pursues those large cap LBO deals, While Silver Lake Semiru conducts middle market investments, Silver Lake Waterman specializes in growth stage funding, and Silver Lake Craftwork invests in the energy and resource sectors. We can observe the growth of Silver Lake Partners, which is the main buyout fund here. In 2017, Silver Lake raised $15 billion for its fifth buyout fund, and this is one of the biggest ever devoted to tech deals. And more recently, it seems that the focus of Silver Lake is starting to move beyond just tech. Of course, there was that recent $500 million investment into Manchester City owners Manchester Football Group. Silver Lake is also a major investor in Endeavour, which is an amalgamation of William Morris and IMG talent and sports agencies, and a large collection of acquisitions and other investments which include the UFC. And finally, as a side note, in 2004, McNamee, one of the original founders of Silver Lake, left to form a new firm along with a co-founder you may have heard of, U2 lead singer Bono. And for more compounded valuable content, subscribe and like.